First of all, what exactly is subsidiary book? Why would we need that? And what are the different kinds of subsidiary book? Accordingly, how we prepare or how we make entries into those books. So first, subsidiary book, in which it's going to be a subdivision of journal. So any transaction is happening, we have to cut down into some effects. Like if we purchase certain goods, so it's going to be a purchase, and it's going to be when we are going to purchase goods for cash, the cash which we are going to do. So logically, we are supposed to make entries in the books. So how, which books? The first is going to be the purchase book, and another is going to be a cash book. If we are going to sell goods, then there are going to be two books which are going to get effect. The first book is the cash book because we are going to receive cash, and the second book is sales book where we are going to mention the sales. So these books are nothing but the record of the transactions, and so specific to those transactions, different books will be utilized. Example is we will be preparing certain 6-7 ledgers, certain books which are mandatory. The first is the purchase book, second is the purchase return book, third is sales, fourth is sales return, fifth is debtors, sixth is creditor, and seventh is cash book. These are all very, very essential books of accounts. Now, in these books, what exactly do we going to do? We are going to pass these entries originally in these particular books. So these books are containing all the details of the transactions which are recorded. When the transaction is happening on the same day, entry should go to the subsidiary book, so that it becomes easy for collecting, analyzing, recording the data. Whenever the transactions are happening, so far the entry should go to these particular books. So it will otherwise become impossible to recollect, to remember which the transactions happened if we forget to mention in the subsidiary books. So these subsidiary books are going to record every transaction, and based on which we are going to make the ledger account. So ledger, we know in the last session we had considered some cash account, purchase account, sales account, those all ledgers. So future reference and any desired analysis if we want to make out of these books, it becomes possible when we record all the transactions in the subsidiary books. Now the next here is, what are all those important subsidiary books? So first becomes is used records of all the cash transactions. So cash book is going to be maintained. We in a business extensively we are going to use cash. So cash inflows will be there. The cash is received in the business when we are going to make sale, when we are going to sell any asset, or when the capital is introduced in the business. So there are the three avenues when we are going to receive cash. And there are many of the areas, many of the reasons for which we are going to spend certain cash, like payment of wages, salaries, electricity bill, audit fees, legal fees, printing stationery, traveling, then conveyance, and then postage, telegram, and discount we will be allowing. And likewise, there are so many reasons of spending. Few reasons which we receive is out of the sale proceeds, out of the sale of assets, or maybe we receive interest, we receive royalty, we receive commission, we receive rent, we receive discount. So whatever are the receipts, those are all considered as the cash inflows. And there are going to be many of the payments for the expenditures. So those are the cash receipts, that means which we are going to receive, and payments are the one for which we are going to make the expenditures, the outflow of money from the business. The next is the purchase book, which is used to record all the credit purchases. So credit purchases are going to be mentioned in the purchase book. Sales book, it is used to record all the credit sales. So purchase return book, that means such book where we purchase certain goods and we return those to the supplier again. Okay, we purchase goods, but for some reason, whatsoever the reason, we have returned those goods to the supplier, those entries would appear in the purchase return book. Exactly opposite concept to purchase return is the sales return. That means we have sold the goods to our customer and now customer has returned goods to us. So the customers to whom we have sold goods are going to return goods. That means goods are going to return because we made sale. So it's going to be sales return. Bills receivable books, that means all such book which we are going to accept as as a bills receivable. So if we are going to make certain invoices for the customers from whom we are supposed to get amount, we are going to receive certain amount. Those are all the bills receivable. Bills payable are the one to whom business is supposed to pay. So to the supplier, a business is supposed to pay. So bills payable, supplier, creditor are going to be on one side. Debtor, customer, bills receivable are going to be on the another side. Journal proper. That means we are going to make a separate journal entries for every of this. So this is not going to be a separate book. So this is used to record the transaction for which there is no separate book. So separate book, if it is not mentioned, then we are going to mention it into the journal proper. Any such transaction where we are not going to make any entry in the above books will appear into journal proper. Let's check these books one after another. So purchase book, or we call it as purchase journal. What is going to be there? So purchase book is the original entry in which only credit purchases of goods are recorded. So if we are going to make a credit purchase from anyone, Mr. A, B, C, those all books we are going to maintain for the purchase book. But what if the cash transactions are happening? So cash transactions will be appearing in the cash book. There we are not going to make entry for the purchases. I hope this is getting clear. Purchase book is only when credit purchase is there. Cash purchase will be there. It will get effect into cash book. Credit purchases of other assets are not recorded in the purchase book. They are recorded in the journal proper. For example, if we purchase machinery, which is our asset for the business, it's not going to be into purchase book. We make entries of only raw material in this purchase book. Whatever we are going to purchase for the business process, business outcome, we are going to go entry into purchase book. If we purchase furniture, if we purchase computer, if we purchase vehicle, if we purchase building, if we purchase any other property, then in that case, or if we make any kind of purchases of any other product which is not into the business, then in that case it's going to be into that respective book and not the purchases. On this same context, sales book is going to maintain where only the credit sale entries are mentioned. Cash, if it is going to be sale on cash basis, it will have effect to the cash book and nothing will appear into the sales book. Next is, if we sell only the goods, those entries will appear in the sales book. If we are going to sell machinery, you are going to sell car, we are going to sell any other furniture, then these kind of assets will not have place in this particular sales book. We are going to maintain a separate book, that is journal proper, in which we are going to mention these entries. Then purchase return or purchases return book or journal. So here purchases that we made from supplier, and once we get the goods, for some reason, maybe there are certain defects in the goods, those goods were not as per the sample or specifications, the quantity mentioned is not well, the quality mentioned is not well, and if there is any kind of disagreement, breach of agreement, breach, that means the conditions, terms and conditions are not followed or are not complied, that's called as breach. So in case there is a breach of agreement, in such cases these goods will be returned back to the supplier. And in this case, entry would be made in the purchase return book. Again, sales return will be having same kind of things. We are going to sell goods to our customer, but customer do not find it perfect, or customer finds some defect in our goods. Customer would getting be supply, no, these goods very delayed. So this delay wasn't allowed by the customer. So customer say, now I have received those goods quite late. It's of no use to me now. Get it back to you. Then if the goods are not specified, specifically sold as per sample specifications, if there is an oversupply and the customer do not want those, and if there is a breach of agreement, it is going to be seller and purchase. I'll just give an example. Now this Ganpati festival was just over. There were ample of stalls which were providing the decoration material, and even Ganpati idols were there. Now, what these shopkeepers are doing, they are making an agreement with the manufacturer that if we sell our goods, that's okay. But if we cannot sell this decoration material throughout Ganpati period, or if we cannot, if we are not able to get this ultimate customer for this Ganpati idol, we are going to send back the goods to you. Maybe we can utilize this next year. But there is not going to be I'm not going to retain those all material with me. I'm going to send it back to you. That's an agreement specifically mentioned. Whatever the decoration material is getting sold in my shop, I will sell. Which is unsold, I'm going to return it back to you. That's becoming an agreement. Then in that case, the sales return is going to happen, bound to happen, and thus such kind of sales return book will be maintained. Bills receivable book, in which in the case of credit sales, sometimes a business is drawing certain bill on the purchaser. Debtor, after its acceptance from the debtor, it becomes the bill of exchange. That means there is going to be a bill, and in this particular bill, this debtor is agreeing that he is going to pay to certain after certain time. So we are supposed to receive amount after certain period of time, maybe 2 months or 3 months of credit period. And thus a bill of exchange will be drawn. Bill of exchange is nothing but a bill, in short, in which it is mentioned that now the person have sold so much of quantity of goods for so much of amount, and now you are supposed to pay after 2 months so and so amount. Now when 2 months are mentioned, logically there is no such no reason, but yes, in the act it is mentioned that we have to give 3 more days as the grace period. So if 2 months are there, then 2 months plus 3 days. If 3 months would be there, 3 months plus 3 days. If 1 month credit is given, it's 1 month plus 3 days. That's going to be a period of bill in which it is going to get encashed. So we when we sell goods as a manufacturer, if we are going to sell goods to our customers, and for certain we are going to raise a bill against our customer, and the customer is going to accept the bill, and customer says that yes, after 2 months I will be making the payment. So we have to wait for 2 months. So our amount is receivable and not yet received. After 2 months plus 3 days, this customer is going to pay us. Now, if he pays, it becomes our money, like the money we get. That is, we are going to make entry in the cash book that we have received. But what if the debtor, that is the customer, has not paid after the specific time period? In this case, it is due for payment but not received. That becomes a bad debt. On the same context, bills payable. Now here we are the manufacturer, and we are going to make certain purchases from the supplier. So supplier is a person who is going to give us goods on credit for suppose 3 months. So he has given us 3 months time period for making payment towards the purchases. So here we are supposed to pay after 3 months plus 3 grace days. So in case we pay, then it is going to be a cash outflow from our business, and that another person, the supplier, is going to mention it as cash received. If we default in making the payment, the customer, sorry, the not customer, sorry, the supplier is going to make entry as the bad debt from our business. Cash book, the last we can say. So cash book is such transaction where all cash entries are mentioned. So wherever we are going to make any entries, those all we consider original book as the cash book. It is going to play a dual role. Dual role is what? Wherever we receive cash, we are going to make entry. Wherever we are paying cash, we are going to make entry. So where it is dual role, received, receipt and payments. So it's a both book of original entry as well as book of final entry. So all the cash transactions are primarily recorded in it as soon as they take place. So it is a journal book, original. And on the other hand, the cash aspect of all transactions are finally recorded in cash book. So a cash book is also a ledger account. Now what's a final entry and the primary entry? Let me just give you this clarification. If it's a purchase, goods purchase on cash basis, we are going to mention in the cash book for sure. If it's going to be a purchase on credit basis, no entry will appear in cash book. Entry will go to the bills payable account, या फिर the creditors account and purchase book. So purchase book entry would be there. When against this credit purchase, when we are going to make payment, so we are supposed to make payment to the supplier after suppose 3 months. After 3 months, when we are going to make a final, full and final settlement of transaction, that time we are supposed to pay cash. So finally, when we pay cash, it's going to be a final entry again in the cash book. So even if the transaction is happening and nothing comes at the primary level, at the final entry, the cash will be effected. Now, petty cash book. Petty cash book, that means small expenditures are there all the time. So maybe tea allowance, tea is served in the office, postage, telegrams, some stamps, we require food, fuel, electricity, supplies, newspaper required, traveling, little traveling required, a conveyance is prevailing and conveyance allowance is given to employees. Those all expenditures, some small expenditures will be considered as the petty cash book. Every business is going to maintain certain petty cash book with them, and they are going to mention some small amount expenditures and incomes. Usually they are going to be the expenditures. Usually it's going to be expenditure and not the one, there is not going to be certain monies which we are going to receive. These petty cash book will be largely having all the expenditures which are of a small in nature, like T bill paid, certain recharge amount paid, then certain traveling allowance paid. We are getting newspaper in the office, then we are paying newspaper charges and fuel charges, food charges. If the certain guests have arrived, we collect some no we get some certain good food for them, refreshments for them. So such kind of expenditures will appear in the petty cash book. So this is going to be all small expenditures, but the details are supposed to be provided for what the for what reason the entries are made, the no, the monies have been spent. So here purchase book, purchase return book, bills payable book, and with the creditors, or we call it as the supplier, or we call it as the vendor. These are all going to be at one side. Then sales book, Sales return book, bills receivable book, then the debtors, or say the customers. Here it can be B2B, or it can be B2C, or it can be the to the seller as a wholesaler, or the to the retailer. Those can be there. I mean, from the business, we are supposed to, we are supposed to okay. So this is what is been prepared. Purchase book, purchase return book, bills payable, and here it's going to be bills receivable, debtors book, and customers B2B, and wholesaler and retailer. Some of the purpose, advantage, disadvantage, how we prepare that, how the format of trial balance, and how we prepare that, why we prepare that, and how the balancing is done. Trial balance, the name which suggests that it is on a trial mode and it is containing the balances. Now, which balances are contained? Let's take an example. Throughout this year, from 1st of April to 31st of March, frequently we have sold goods. Okay, we sold our certain manufactured goods. So throughout the year, there is going to be certain amount of goods which we have sold. That certain amount collected in a summarized form, we are going to mention is as the total sale throughout the year. Now, throughout the year, we are going to make certain purchases. So all those purchases from 1st of April to 31st of March, a collective of amount we are going to mention under the head purchases throughout, total purchases throughout the year. Throughout the year, we have paid salary every month to our employees. The total of all the salaries on the day or the year end, we are going to mention in the salary account. That means how much of salary paid to the person. Likewise, wherever, however, the accounts which are going to prepare, the expenditures we are going to mention, all those entries would appear in the trial balance as the summarized form, a big gross amount. The big amount or the addition of all the expenditures made throughout the year will come under this trial balance. By looking at the trial balance, we can immediately see the bank balance, loan balance, owner's equity balance, etc. How much is capital introduced throughout the year? How much of the bills are raised by the creditors? How much of bills are raised on the debtors? How many are the purchases? How much of sales? How much of salary we have paid? How much of rent we have paid? How much of discount we have received? Or how much of discount we have given to our customer? Then how much of interest we have received, maybe from bank? How much of bank loan we have obtained throughout the year? So all those balances, all those final big summarized amount would be mentioned in the trial balance. So this is the third stage. Now, why I talk about third stage? The first stage, the very first stage is the journal account, journal entries. That means we are going to mention in the subsidiary books, and on which we are going to consider this book as the number one journal book. Second, we are going to make the entry to the ledger. That means we are from the journal, we are going to post to the ledger. Now, this ledger account will be getting certain balance. Now, how the balance is received, let me just show you. File. Now, when all accounts are prepared, we are going to see only the cash book as of now. This is the cash book, okay? Some amounts, some areas by which we have received this amount would be there on the debit side. This is debit side. Those amounts which we have paid for certain period will be there on the credit side. Now, we have to make the balancing of the same. How we are going to make it? Let's check. Here, if we check 10,000, 170, 9,000, 15,000, 25,000, 530, it's going to be there a certain amount. And here it's 40,000, 40,000, 12,000, 2,000 and 3,500. Here logically I need to understand which amount, which side is a bigger one. So here credit side is the heavier one. So heavy in that sense, it has got more amounts as compared to the debit side. So what I'm going to do is, here I'm going to take the total, then total of all the credit side, take it to the debit side, and from this amount of 59,700, remove all those above accounts, all these above figures. So from this 59,700, if I minus 10,000, minus 170, minus 9,000, and minus 15,000, I would receive this as the balance. So this is going to be my balance. So what this balance calls for, that my payments, that is, these are the payments areas. So my payments were more than my receipts, and this much of balance I am supposed to carry it over. Now, this one was made at the balancing is always done at the year end. Wherever there is going to be there, it's going to be at the month end or the year end. So balancing is not done in between the month. It's always going to be there at the month end. So what we are going to do is, we will be balancing this on 31st of December, and that is the last day of the month. Now, we are going to open this balance. If it is the balance is carried down at the debit side, we are going to open this at the credit side for 1st January 23 to balance brought down the same amount. So the same amount is brought down for the next month with so and so of the outflow. Now, from this amount, we are going to suppose there is going to be entry on 2nd of January. No, any entry would be there. Suppose there is going to be entry on 2nd January, some entry on there on 11th January, suppose, and suppose there is going to be any entry on 2nd January, 5th January, 6th January, and again going to be there on entry on 15th January. So all those entries we are going to make here. As on 31st December, then whatever the balance comes, okay, let me tell you that also. Now, there is going to be certain amounts, okay, whatever. If there is going to be certain transaction here of say 10,000 amount, here comes 5,000, sorry, 50,000. So if it's going to be 50,000, on 6th of January, the transaction was suppose 4,000. And here the transaction was suppose 2,000. Now, Here some of the expenditures which were made for 6,000 and here 2,000. There are no entries further. So on 31st of January, what will happen is I need to check which side is heavier. So in this context, I would see that the credit side is heavier. So I'm going to take the total here. It's total. I'm going to take this amount, all those amounts. Now I would be taking over this because the debit side was heavier. $66,000 because this side heavier it was there. I'm going to mention here as the total for this month. 66,000. I'll be taking the same total 66,000 to this side 66,000. So a balance would appear at this particular side. So here I'm going to mention it as by balance carried down. So by balance carried down. So from this amount, I'm going to minus this. Yeah, this amount, then this amount, this amount. I'm going to minus. This is going to be my balance carried down on last day of the month. I'm going to make it open for the next period now. Okay, so here I close the that particular month. Now from 31st January over here, the balance which is carried down, I'm going to open it to the next month. That is 1st of February 2023. I'm going to mention it as to balance brought down. Now earlier I carried down here. Now I'm going to brought down here the same amount 32,470. Likewise, every month I'm supposed to do the totaling and balancing till 31st of March. So till 31st of March, whatever the amount comes, that would appear in the trial balance. So this is something we call it as the totaling and balancing of ledger accounts. The trial balance would need to be third stage. So first is journal, the second is ledger, and the third stage is going to be the trial balance. Once the balances we are going to receive, we are going to make certain adjustments on the same. And then we are going to finally do the final accounts. So these balances are prepared as a summary of all the balances and names. So what is the purpose of preparing the trial balance? So the trial balance is going to prepare the statement of disclosure of accounting balances for various ledgers and throughout the period, that is 1st of April to 31st of March, whatever accounts were prepared, those all accounts will be totaled and balanced out, and then they will be mentioned in the trial balance. This trial balance is prepared for making these P&L, profit and loss account, trading account, and balance sheet. So balance sheet, profit and loss account, trading account will all be prepared for the last day of the year, that is 31st of March. All those entries, trial balance must tally because everything will be having double effect. So logically, this trial balance is going to get tallied. Now let's go by certain thumb rules. How to make a trial balance? So we have to take the balance. This is because we are going to take the balances from all the ledgers and enter them into our trial balance table. So how do that? Debit side, it will be having debit side, it will be having credit side. So debit side will reflect all the assets plus all the expenditures and all the drawings. Drawing, that means whichever we are going to take out from the business. Credit side will have all the liabilities plus all the incomes and the owner's equity. Owner's equity, that means the capital. Assets would be at the debit, will be having debit balance. Liabilities would be having a credit balance. Expenses will be having a debit balance, and equities and income will be having the credit balance. Let's check this one. This is same. Now you know the golden rules, right? The personal, real, and nominal account rules. There is debit side of personal, real, and nominal. Personal account debit side is debit the receiver. Nominal account debit side is debit all the expenditure and losses. And real account debit side is debit what comes in and all the assets. Debit all assets. Now, these are all debit side would become the debit side of trial balance. All the credit sides of real personal nominal would become the credit balance of trial balance automatically. Now, this credit balance are the major source for the half of the golden rules. Like here, on the credit side of personal account, it's going to be credit the giver. Nominal account rule is credit all expenditures and credit all income and gains. And real account is credit what goes out and credit all the liabilities. This is going to be the credit rule. All the credit rules combining together will form the credit balance of the trial balance. This is going to be a format of trial balance. Those all particulars will be there, like purchases, sales, purchase return, sales return, salary, wages, electricity bill, machinery, liabilities, any bank loan will be there. These all areas will be there at the particulars here side. Amount would be either at the debit side or would be at the credit side. So as I mentioned, all the expenditures, all the assets are going to be there at the debit side. All the incomes, all the liabilities and the owner's equity, that means the capital, will be there at the credit side. Balance. Drawing is always having the debit balance. So it will always appear at the debit side of trial balance. Bank account will usually consider at the debit side. XYZ Limited depends what is exactly doing based on which will be there. Creditors will be having credit balance. Debtors will be having the debit balance. Cash usually is mentioned as an asset, so it's going to be on the debit side. Machinery is going to be there on the debit side, land on debit side, building debit side, goodwill on debit side. All assets are mentioned at the debit side. Now here is some difference. Salary, it's an expenditure, it's going to be on the debit side. Electricity bill, it's an expenditure, it's going to be there at the debit side. Audit fees, again going to be at the debit side. Traveling expenditure, again debit side because it's an expenditure. Advertisement, it's an expenditure, so on debit side. Next, discount received and interest received. Here, these two are the incomes that would appear at the credit side of trial balance. Let's check this. Interest on capital. Now, when capital is introduced in the business, a business is supposed to pay interest to the capital. So for us, interest is going to be the expenditure. So would appear at the debit side. Creditors will be having a credit balance. This is going to be at the credit side. Discount received is our income. So it's going to be on the credit side. Loan is our expenditure. We are going to mention it, but bank has given this loan. So for us, it's going to be a liability. So appearing at the credit side. Purchase return, that whatever are the, we are supposed to return those goods, and by which we are going to get certain monies back. So it's going to be income for us. So it's going to be at the credit side. Sales return, by way of sales, when we had sold goods, we received money. But when we do the sales return, we are supposed to pay back to the customers. So it's going to be expenditure for us, the debit side. Advertisement, expenditure, debit side. Commission received, our income. So it's going to be at the credit side. Rent is our expenditure, so debit. Purchase is our expenditure, so debit. Opening stock will always be mentioned at the debit side. Salary is our expenditure, so debit. Capital, it's going to be an income for the business, so it's going to be on the credit side. Drawing is an expenditure for the business, so it's going to be on the debit side. Machinery is an asset, debit side. Bills payable, again a liability on the credit side. Furniture on the debit side. Debtors, debit. Bank loan again on credit side. Patent is an intangible asset on the debit side. And sales, finally, again it's an it's an income for us. It's going to be on the credit side. Likewise, we are going to mention this all. We are going to prepare the trial balance in this particular format. Some of the items would appear on the debit side, some of them on the credit side. Please note these